My name is Ms. Imelda, AI assistant of Dr.V.V.L.N. I am narrating the script of Dr.V.V.L.N. jurist, international arbitrator, financial economist and Fulbright legal scholar. Friends, today I wanted to inform you a critical issue that affects lakhs of depositors of New India Co-operative Bank. Please listen carefully because your hard-earned money is at stake. Why is DICGC insurance being pushed when the bank is not in liquidation? The bank is under RBI restrictions but not under liquidation or merger yet. So why is bank staff giving out DICGC claim forms? Here's what might be happening. 1. They may be testing how many depositors will silently accept 5 lakh rupees and walk away. 2. They could be trapping large depositors into signing away their rights to money beyond 5 lakh rupees. 3. It could be a pre-planned move to justify closing or selling the bank at a lower value. 4. Once depositors accept the 5 lakh rupees payout, their claim to the remaining balance may be extinguished. This is not a normal process. Beware before signing anything. If you fall into this trap, you could lose lakhs of rupees. Be aware and protect your financial rights. Current status of the bank, not liquidated, just under RBI restrictions. New India Co-operative Bank is under RBI imposed restrictions, meaning it has operational limits, such as withdrawal caps, but is not yet under liquidation, amalgamation, or restructuring. DICGC, Deposit Insurance and Credit Guarantee Corporation, normally comes into the picture only when 1. The bank is officially liquidated. 2. The bank undergoes forced amalgamation or restructuring. 3. The RBI issues an official directive triggering DICGC payouts. Since none of these conditions are met, depositors should not need to claim DICGC insurance at this stage. 2. Why is bank staff distributing DICGC claim forms? Red flag. This is not a standard banking practice unless liquidation or forced restructuring is imminent. Possible reasons, potential tricks behind this move. 1. Testing how many depositors are willing to settle for Rs 5 lakh and walk away. If a large number of depositors submit claims, it signals weak resistance to an eventual closure. Or this could be used to justify liquidation or a forced sale at a lower value. 2. Trapping large depositors into limiting their own claims. If a depositor voluntarily fills out the DICGC claim, they might be waiving rights to excess funds beyond Rs 5 lakh. Or this would trap high-value depositors into settling for less if the bank is later revived. 3. Creating a false narrative that depositors prefer closure over revival. If depositors start claiming insurance money, authorities can say, since most people have taken their Rs 5 lakh, the bank has lost depositor confidence. It's better to shut it down. This could be a move to manufacture depositor consent for liquidation. Preparing for a low-cost takeover by a strategic buyer. If the bank is quietly preparing for a forced takeover, reducing liabilities makes it more attractive to a buyer. Encouraging DICGC claims now reduces the total deposit burden, making it easier to offload the bank at a discount. 3. Should depositors fill DICGC forms? Absolutely not at this stage. Until the RBI declares the bank for liquidation or restructuring, depositors are legally entitled to their full deposits. Filling the form prematurely can weaken their legal claim to amounts exceeding Rs 5 lakh. DICGC insurance should be the last resort, not the first step. How should depositors respond? 1. Demand clarity from the RBI and the bank's management. Ask why forms are being issued before liquidation or restructuring is declared. 2. Form a depositor group to oppose any moves that could force depositors into claiming prematurely. 3. Do not rush to submit the claim forms. Filing a claim early could lead to forfeiting larger deposit amounts.